Mike, if I told a business owner they could start their own insurance company, keep the underwriting profit, and potentially save six figures a year, they'd think I was running a scam, but that's essentially what a captive is. Why don't more people know about this? I'm Blake Erickson with DSP Insurance Services, and this is Uncovered, where we dig into the business decisions behind insurance that most people never think to question. Today, I'm sitting down with Mike Pohl, one of our property and casualty producers and shareholders, to uncover how captive insurance works and whether or not it belongs in your playbook. Mike, can you give me a quick 15-second intro?
Yeah. Mike Pohl, DSP, been with the agency about 12 years now, mostly on the property and casualty side as well as the surety side. I would say my special area of focus is more on the construction, but generalist for the most part as well.
Awesome. Thanks, Mike. So in plain English, let's jump straight into today's topic. What is a captive insurance company? If I'm a business owner buying from Travelers or Hartford right now, how is a captive fundamentally different?
Yeah, so you got your Travelers or Hartford, the standard market, where a captive is more than slightly different, but has some common elements as well. Where a captive, you, in theory, are looking at a group of better performing insureds that are looking to take a little more control of their insurance future. So they will get together with a group of like-minded, safe companies. At the start of these captives, sometimes it might be 15 companies, and typically they'll grow to about 300 or so companies. And they form their own insurance company, the captive, and that captive will typically work with one of those big names, kind of behind the scenes with reinsurance, AIG, Hartford, Travelers, and the likes. But the whole goal is to find safer companies to invite into your insurance company that you form and perform better than the average.
So walk me through the mechanics for a minute. Day one, a business owner sets up a captive. Where does the premium money go? Who runs it? What does the org chart look like? Are they starting a whole nother company and hiring employees? What does that look like?
Yes and no. So most of these things, especially group captives, which is kind of what I'll be talking mostly on, are going to go through a group administrator, and there's a good handful of them throughout the country, and a lot of them are kind of domiciled in the Cayman Islands. But they will have a team of 3 to 5 people that will be focused on that captive group, and from the insured standpoint, everything after you get it all set up should feel very similar to a standard market, where you're still going to work through the broker who introduced the captive to you, DSP Insurance for instance, and they'll do a lot of the behind the scenes stuff with the captive administrator. The insured will have to participate, though, in typically at least 2 annual meetings that the captive will organize, usually in nice little areas, Cayman Islands, go over to Europe, Canada, fun little spots. But for the most part, once established, it'll feel and look the same. Your certificate of insurance will show AIG, will show Travelers. It won't necessarily show the captive that you're a part of. So it can kind of be a quiet little thing that benefits you in the background.
Got it. So you've still got a fronting carrier, essentially. You've got this captive manager. There's a board overseeing it. Are participating orgs always sitting on the board of these captives? Is that how they're run? And I guess I'll bridge that into kind of my next question. You mentioned, group captives. I understand that there's a couple of different flavors of captive out there. I know I've personally, on the employee benefits side, worked with some single parent captives. But you mentioned group captives. I know there's different types of cells out there, different tax advantages. For the typical mid-market business owner, which type are you usually talking about and recommending, and why that one?
Typically, mid-market, depending on what you're looking at, but somebody $250,000 in standard premium, up to a couple million, you're probably going to be looking at a group captive. There's two types: heterogeneous, homogeneous, and just kind of depends on what you're looking for. I always think that heterogeneous, a little spread of risk is better than kind of a concentration, but sometimes you might not have the ability to make that decision. There's certain types of programs that are put together because it's hard to find insurance in the standard market for that type of risk, but you're performing better than your peers, so you want to try and find a better option. Some of those are trucking. They'll have a homogeneous trucking type captive, roofing captives, or temporary staffing. There's different options kind of across the board. But for the most part, yeah, the group captives, heterogeneous spread of risk is a good play.
All right, that makes sense. So we've covered what a captive is and kind of at a high level how it's structured. So let me ask the question that every business owner is asking, and that's, should I actually do this? Let's take a minute and talk about the money. What's the financial case, Mike? If I'm paying $500,000 or more in commercial premiums today, what does the math look like inside of a captive over 3 or 5 years? What changes?
Yeah, so typically I would say when we see these presented, the upfront premium, it's going to be structured differently. You're going to have your loss buckets that you're going to see more than you would see if on a standard program. You're going to have the administrative fees and all the things that go into running an insurance company. But if you were paying $500,000 before, you're probably going to be paying close to $500,000 after the fact if you went with a captive. From there, where you can start benefiting is if at the end of the year you come out with no losses, for simple terms, you have the opportunity to earn back that first thing we talked about, the loss bucket. The administrative fees, that's going to run the company. That you don't have a chance to earn that back. But anything that's kind of set aside for that loss bucket, you have the opportunity to win back. When you're evaluating, you can kind of take a look at, if you're a better than average performing company where you have a low loss ratio year in, year out. Typically when these captives are presented, we'll kind of show you, hey, at different loss levels, here's how you would have fared. Standard market right here, that's kind of the break even. That's fixed cost programs. You're going to pay $500,000 whether you have any losses or not. That $500,000 is gone. But if you have low losses, they kind of can show you what your return might be 3 to 5 years down the road once claims kind of settle and can be a little more predictable on where those would settle. If you're not as good of a performer, you're going to start getting into the red a lot quicker because there is an opportunity to pay more into the captive if your losses are not favorable.
So I'm going to ask another. I'm going to dive a little bit deeper for a second. I'm going to kind of put you on the spot. So if I'm seeing, say I'm a company that's paying, again, let's go with $500,000 a year. And I typically see, claims are hit and miss over the years, but in general, we've performed well. Our broker's recommending that we move forward with a group captive. What would I expect to potentially see in retained profit or savings over X number of years? What does that math look like? So if I got $500,000, am I saving $50,000 a year on average over 5 years? What does that equation look like, all else being equal at the end of the day?
Yeah, you're typically not going to earn it all back. And one thing that I kind of forgot to mention, these are typically in the group captive space, auto, general liability, and workers' compensation. So you're looking at those 3 lines. Are you going to be perfect every year? Probably not. Is there a possibility, depending on what what type of company you are? Yeah, there is a possibility. But if you're paying $500,000, $200,000 of that goes to running the company, so you have an opportunity to win back $300,000. Depending on what your loss history was like in the past, yeah, maybe 30 to 60% of that you can anticipate getting back. 3 to 5 years down the road once these claims kind of start settling out a little bit.
Awesome. Awesome. So thank you. Go ahead and give me a picture of what does the ideal candidate for a captive look like? What's the revenue range? What's their claims history? Do they need to be proactively managing? Do they need good safety programs? What types of, are there any industries that should absolutely avoid captives? Are there any that are absolute, that it's just a slam dunk decision that they should be looking at it? What's that profile look like?
Yeah. I don't think there's any industries that should really be avoiding it, looking at it. If you're an industry that is not sought after by captives, they're going to avoid you. So if they give you the opportunity to look at it, it's worth looking at. Revenue, payroll, I would say that doesn't really matter. It's 250. They're dropping down to 125,000 in premium for those 3 lines of business, but that's kind of getting pretty low. So 250,000 in premium and above would be a good candidate. And yeah, they got to have a little bit of a safety mentality. You're going to want to see somebody that wants that control. So when you get in, you're going to have the ability to know who's handling your claims, where the money that you're investing into it is being, what it's being invested into. There's, part of the premiums that you pay in, it's going to be set aside for safety. So you're going to be wanting to look into, where that money goes. So somebody that wants more control, has typically a good loss history, and then the big third element is kind of a longer time frame. These things aren't going to start paying out for 5 years. So if you're looking to sell the company in a couple of years, or you don't know what your full timeline is, that can be a big challenge as well.
All right. So if I'm hearing you right, it sounds like we need revenue range, premium range in the $250,000 plus for the qualifying lines of coverage. You need a company with a longer term horizon, someone that's not looking to run away today, and likely someone that's willing to be active in their risk management or in their safety, so that they can actually capitalize on those potential claim savings.
Yeah, correct.
All right. So let's flip that. Who should not do a captive? When does this strategy actually hurt a company to look at? Why should someone avoid going to a captive? What are the dangers involved?
Yeah, I mean, they'll, when you meet with any of the captive administrators and any of the brokers that are kind of talking about it, but frequency is kind of what hurts you the most in these captives. So if you have a high frequency of claims, that's going to ding you more than if you have an industry that might just have kind of a more catastrophic type claim. So it's going to be capped. Your claims are going to be capped at some point. But if you have a lot of smaller claims, that's going to hurt you. So anybody that has a history of high frequency and decent total claim dollars being paid out, it might not be a benefit. Everybody's hearing about captives. Everybody's calling insureds saying, this could be right for you. And, sometimes we'll see it where captive administrators are pitching that, this is a good thing for you. But when you look at kind of the loss possibilities, it quickly can go into the red where you're paying more. So you kind of have to be careful. These captives all have an incentive to grow, and, they'll pitch that, we're only taking the best of the best, but I feel like we'll kind of see from time to time where that's not necessarily truly the case. They need to grow, and they might take you in even if it's not really the best thing for you.
Is there are there circumstances that exist where you can be a good candidate for a captive, but you make a mistake of, and I hesitate to say this, especially on a recorded line as an insurance guy, but where you make a mistake and you pick the wrong captive, a captive that's currently in the process of dying or performing poorly or doesn't have enough participation or has too broad of a risk pool or too much participation. It wasn't something I was really planning on talking about today, but I do think that that's probably a relevant piece of the context, and I I don't have firsthand experience in that world with captives myself, but we've seen it with association health plans on the group benefits side year over year. In group benefit captives have become much more popular over the last 5 to 7 years, with a couple of, forerunners that scaled from essentially nothing to thousands of participating groups in a matter of a handful of years. And it's been interesting from my perspective, not having played a lot in that space, looking at a number of these organizations and seeing that growth has kind of stalled out recently over the last 2 years or so. That they kind of boomed out of nowhere, and now they've just been churning clients in and out. I'm just curious, is there risk involved just when it comes to a captive setup, especially if you're joining a group captive with other organizations that's managed by someone, not just solely by yourself?
It could be. I think things have been pretty good as of late, but if you kind of look at the history of them, they'll talk about in 2008 when the market was absolutely getting crushed. That construction-focused captives kind of were some of the leaders and who was hurting the most. Contracts just weren't going through. Nobody was spending money, public or private, and those guys very much struggled throughout it. There could be, market swings can affect it where, if some of these captives are a little too aggressive on their investment approach, they can be hurt there. But when you're going into it, you should have access to all of that information. They should show you their investment strategy, the makeup of the captive, so you can not necessarily see every name that's in it. You can, but when it comes down to the financial performance of all of those individual companies that are in it, they're going to have a kind of a number tied to them so that you don't know exactly who it is, but you should be able to see the makeup, geographic spread of that risk. And if you want to avoid risk, it's definitely better to get into one that's more established, has built a good, bank account, basically. When they're starting these new ones, there could be a lower amount of companies involved, and larger claims or frequency can quickly affect those ones. So there's ways around it, and you should have access to all the information to make a good decision.
So, Mike, take us inside a real client's journey for a moment without naming them. What was their situation before the captive? What did the transition look like, and where are they today?
Yeah. I think I'm going. I guess one of our, kind of first ones that we have the most data on, distribution company, kind of focused in the Chicagoland area that had a decent amount of transportation exposure. And auto, obviously, has not been a favorable line for some years now. Whether you perform well, you perform poorly, you're going to get double-digit increase on your standard market renewal. So they explored the captive, went into it. North of 100 vehicles on the road, 300 employees probably overall for the company. And, they were getting sick of the increases, whether they performed well or not. And they joined the captive. And, through that pool of lost funds it's use it or lose it. So, there might be in your program of $700,000, they might set aside $40,000 for safety that you either use and you get that pool of money for it. And if you don't use it, it goes to the captive administrator, and it doesn't come back to you. So they started putting in telematics and different, things to kind of help their over-the-road exposure and losses. And, it's probably been about 5 years. Premiums have been pretty stable. You're still going to get increases in the program, but overall, I would guess that their 5-year return is going to be north of $1 million. They pay in about $700,000 in premiums, so they have performed well, and they are starting to see that money back slowly. We're about 5 years in, so I think they've seen maybe 2 years worth of distributions, but overall, it's performing extremely well for them. But they've kind of stuck to what they've always done, and are just really putting an emphasis on safety and accountability through their drivers and kind of managers, I guess.
Awesome, awesome. I'm glad you hit on exactly kind of where they're at now, handful of years down the path. Was there anything during the process, as they first got set up or made the move to a captive, that caught them off guard or was demonstrably different from how they'd operated their insurance programs in the past?
No, I mean they were all for it. Not on this one. No.
Okay, fair enough. And then I know you said that client's running in this example about $1 million a year in savings after 5 years on roughly a $700,000 a year spend. So, call it $3.5 million, saving $1 million. They're saving 30%. How long did it take before the program started to illustrate some savings? Were they saving year one? Was that just because they happen to run well? What's the timeline like before most groups start saving? I know we say this is a longer term strategy, but are there savings to be had in those earlier years at all?
There are. I mean, it's illustrated, so you'll see through different financial, couple times a year you can kind of see where you are, and then at the annual meeting they'll show everybody's financials lined up, and so whether you're getting the returns yet or not, you can have a pretty good idea of what you could expect, depending on how those current losses that might be on there, how those play out over the next years, and whatever their expected losses that could pop up. But you'll see what your savings are. You just might not be getting it right away.
All right, fair enough. So the financial upside's obviously there. Mike, when you're bringing up captives to a business owner for the first time, what's the number one pushback that you hear?
I don't know. It's there's a little bit of work that goes into it, more for the broker than the insured. And I usually try and bring up, some of the negatives, because the captive administrators are fantastic with their presentations, and they'll kind of concentrate on a lot of the positives, which there are a lot of positives, and it is very unique and cool how these things work. But I try and bring up the collateral requirements, what those collateral requirements will look like if you have a bad year, if you have a string of bad years, the time that you'll have to take to go to the meetings, the safety meetings throughout the year, which is all, can be viewed as, something that they have to do or something that is an absolute positive. So if somebody's not dying to do those things and not willing, maybe that's a red flag. But usually I'll try and focus on the money side of things and the amount of time it's going to take for those returns and how captives might be looked at if they are exploring a private equity sale or something like that. To unwind it can be not so much challenging, but just an extra step. And if you're looking to sell and somebody's not about the captive, then they're going to pull it immediately.
So, Mike, for someone who's listening, who's now thinking, I want to explore this, I want to take a look at captives for the first time, what's the actual first step? What does the evaluation process look like before a company signs off, before they commit to this?
Yeah, so most of it is going to be similar to the information that you're already providing your broker. You got to let them know that you want to explore it. What type of captive you might want to explore so that they can find the right captive group to put you with for consideration. And then there just might be a little bit more of a deeper dive on 5 years of losses. So they're going to want to look at least every claim over $100,000, tell us what happened, type of thing. So you might have to provide more information than you typically would for those. Premium history, you're going to have to provide 5 years worth of audited premium history, and they're going to look for kind of exact figures. So how many autos did you have each of those years? What was the actual audited payrolls? What was the actual audited premium? That kind of stuff. So it's more detailed. Once you get into that, they'll typically take what they pump out as far as their premiums are, their administrative fees, and they'll compare that to your standard program if you have, or large deductible program at the time. And you can kind of try and compare it and see what you think is better over a long period. And then if you decide to, green light it, you got to figure out how the two shares are going to be split up, who's going to hold those, how are you going to want to pay the collateral. So you can do a letter of credit, which you're going to pay for through the bank. You're not going to earn any interest. Or if you have the cash available, that's the better option, because that will be invested, and you'll earn investment income throughout the years. And then once you do that, you're kind of off and running, quarterly pay typically, and just keep those losses down.
Before we wrap up, Mike, I want you to hit us with one piece of advice for a business owner who'd never heard of a captive insurance before hitting play on today's episode. What would you tell them?
Always worth asking, your current broker about, to see if it is something worth exploring. It's been a big, everybody's been pushing them a lot, and I feel like maybe sometimes pushing a little too hard on companies that it might not be a perfect fit for. But it's worth a conversation, especially if you're paying north of $250,000 for those 3 lines of coverage: general liability, auto liability, physical damage, and workers' compensation. So can't hurt, especially if your losses are low. It's worth seeing and taking that extra step, whether you move forward or not. What's the harm in just seeing what it looks like?
All right, Mike, thank you so much for breaking this down today. If anything in this episode sparked a question, you can reach out to us at dspins.com or connect with Mike or me on LinkedIn. We'll link everything in the show notes. Next month on Uncovered, we're sitting down with a CPA to talk about what your accountant wishes you knew about how your insurance program affects your tax picture. Until then, I'm Blake Erickson. Thanks for listening. Mike, thanks again.
Thanks, Blake. Have a good one.
You too.